Okay, time for Q&A from the last market outlook. I've been through the questions, and I'll tell you up front, there's a lot of, I don't know. So when I get to these questions, I'll just say it, I don't know. I like the Oklo analysis, long list out there, magnificent opportunities. I don't know if I thought that Oklo was an opportunity. It is a story stock, and a story stock is driven by headlines because it has no fundamentals. You can't look at its financials and say, oh, here we go. But the danger with story stocks is there is no limit to the story that you can tell. Much of it will be far detached from the reality. And if we're looking for bubbles today, nuclear clearly is there. What else is there? Quantum. That is in a ridiculously stupid bubble. Rare earths, if you understand how these things are produced. Massive bubble. They are not rare. What is difficult is finding them in concentrations that you can mine them. And then once you mine them, separating them is brutally difficult to do because they react pretty much all the same way to a chemical reaction. So if you have some chemical treatment on this to separate it from the rest of the stuff that you pull up, and they all react the same way, you end up with just a bunch of them together. You still are not separating them. That's the difficult part. And the U.S. has no real capability in doing that. So yeah, that is in a massive bubble right now. So I don't know that I was talking about an opportunity. You do have it in quotes, so maybe you're recognizing that this is really just narratively driven. Two-part question. One broad, one more specific. Seen over the last year a massive explosion of income generation ETFs, such as yield max products, sometimes with ridiculous yields. What do you make of this? Is this a sign of frothiness in the market we're in? I don't know if I'd say it's a sign of frothiness. These have been around for a long time. Mostly they're covered call funds. They'll hold income producing securities and then they'll sell 30 delta calls against these, never with the goal of having them called away. They always just cover the call if it's underwater, and they sell more calls. I don't know that I'd say that that's frothiness, but I haven't followed them, so I don't know if your adjectives massive explosion is true. Curious to have your thoughts on more humble income generating ETFs, such as, for example, 9-point CCHI. Uses up to 25% leverage, sells up to 50% of its NAV in covered calls, mostly in Canadian blue chips. Target yield of 15% for someone who doesn't have time to trade options of these kind of products. Yeah, if you don't want to do it yourself or you don't have the skill set to do it yourself, sure. Just to confirm, in addition to applied level sector study write-ups for the energy sub-industry, there will also be video lectures covering each of them. Yes, there will. I just finished the first one now, and I'm on the second one. So the sector has a video. And then each of the sub-industries, there are two sub-industries in the services. There's drilling and equipment services, and then there's a number of sub-industries under oil and consumables. Then you have carbon capture, which is a separate video. Then you have hydrogen, understanding hydrogen, which is a separate video. Then you have biofuels, separate video there. Carbon, hydrogen, biofuels, liquefied natural gas. And then on top of all of this, you have one trading video using derivatives, listed derivatives for the energy sector. I'm going to cover CL, NG, RB. I believe there are HO for heating oil, and I think there are some other ones that are covered as well. So yes, they'll all have a video. From your perspective, do algorithms tend to make market swings like sell-offs and rallies sharper? Or are they more about keeping things efficient? Inefficient and efficient. You have momentum algorithms which will drive prices higher and drive prices lower. You have volatility algorithms which will drive prices lower on the way up and drive prices higher on the way down. It dampens volatility. So some increase volatility, some dampen volatility. I'm not familiar with the number of algorithms and the money behind these algorithms that are doing one or the other to have an opinion on it. Have you looked into Verizon? I did sell puts on Verizon, yes. You referred to UPS as a network system, and I do have puts on UPS. Which framework or process do you use to evaluate a company's management as good or bad? Well, stock performance is the biggest thing. Economic value created is another big one. But I don't know that I would say, I use the Robinson-Thompson framework. I don't think there's a name for what I do. If you have a company that has got, 3, 4, 5 years of earnings behind it with a history of more often than not beating expectations and a rising stock price, and rising economic value added, you can attribute that to good management. What are your thoughts on energy transfer? I don't know what that is. I saw you sold some puts on oak. Yep. I think pipelines are being beat up due to nuclear. I wouldn't say no. I wouldn't say that. Oil will flow with or without nuclear. I don't know that there are any petroleum-fired power plants, natural gas-fired power plants, but they'll continue to exist. It's not as if nuclear is replacing these. Nuclear is being added for these data centers. It is the incremental supply. So I don't know that I would say that nuclear threatens the natural gas or the oil trade. Those are under pressure for their own reasons. Midstream, if you think about E&P, and at the very end you have refining, you can think of them as being on a scale. When oil prices go down, E&P suffers, but refining margins increase. And when oil goes up, E&P does very well, but refining margins decrease. Midstream is that balance in the middle. It has typically low volatility, high payouts. It's not really known for a lot of capital appreciation, and in a market that just keeps hitting new highs and new highs and new highs, there sometimes is very little need for defensive stocks like midstream, like staples, so they tend to underperform. But if you like the dividend yield and you know how to use the options to get 2x or even 3x the yield, you can do fairly well with these low vol stocks. I don't know that I would blame it on nuclear. ZQ, December contracts 96.96, October 96.92. So you're happy today. Currently have 2 for December, 5 for October. Total portfolio around $1 million. Position sizing for this type of trade. If I'm looking for a hedge, I'm thinking I hit a delta of 50 to 100K to hedge the portfolio. A delta of 50 to 100K. I don't know what that means. I have sold puts with a notional value of around 250. 500K in cash and the rest in 2 positions which are already hedged with puts. I'm not following what you're doing here. I have no idea what you're trying to say here. You hit a delta of 50 to 100 to hedge. I don't know what that means. I'm going to pass on that. Do you have a target return per year? No. It's a more risk-reward situation based on individual stock. It's opportunity. and you don't have to be right 100% of the time, but you do have to be systematic 100% of the time. And if you follow your process, if you're systematic and you look to get on base, each trade you're not trying to knock it out of the park, you're going to get on base, the runs will come in on their own. If you were in your mid-20s, just finished school, would you go into academia? Or do you think you'd lean more towards industry or entrepreneurship? Well, I did. I did not lean towards industry. I stayed in school. I always stayed in school, a course here, a course there. But I started my own business. I went into my own business, so always the entrepreneurial path and always academia. Not so much as a directive, more of a hobby for a while. Then it became, part of the entrepreneurial thing I did. Today, I don't know. I don't know what I'd do today. I think AI would terrify me. And faced with the prospect of, graduates not really getting jobs, it would be entrepreneurship by necessity, more than likely. If you went the entrepreneurial route, limited capital, what kind of business would you want to start? Well, I have limited capital, so it's going to have to be something I start with my own human capital. It can't be these big projects which are asset heavy, where I have to start and hunt around for investors. It's got to be something that with my own human capital I can get done. Mid-20s, I don't know what that would be. Given your recent analysis on Costco, would you buy 3 to 6 month at the money call? No, I'd never buy call options with interest rates at 4%, because stocks are priced on the forward curve. So if you bought an at the money call option 6 months out, thinking that it's at the money here, its delta would be somewhere around 0.7, because this would be the 0.5 delta on the forward curve. So you're paying a lot for the interest rate over that period of time. Do you go live on a schedule? No, I don't. I probably should, though. I probably should have some schedule for that. More sporadic, yeah, possible. You can send a notification when going live. I do an at everyone when I go live. Relatively active on Discord, but it's been ages since I've joined a live stream. Yeah, I don't really do it often. Can we cover Lululemon or Adobe? Lululemon and Adobe is well covered. We're very familiar with their business models. There's lots of analyst coverage on this. Something like Oklo I thought was interesting because it was up $10 on a day when the market was just down. You got to look into that, and especially with volatility, implied volatility, 130, 140%. What the hell is going on? That's interesting. The story stocks are interesting because you have elements of behavioral momentum and volatility. So many ways to trade that. Very dangerous directional stocks, though. Very dangerous, but looking into those things it can be interesting. Lululemon, I don't know that I can add much to it that you can't read in multiple sources online already. I like that you explained really clearly the gold silver pairs trade, but I feel like your thesis might have a big... Oh, I answered this. You're suggesting that it's my thesis. It's not. I said if you feel that silver is going to outperform gold and you want to isolate the industrial component, here is how you would do it. I wasn't putting it forward like, I'm doing this tomorrow. Everybody should do this. I'm doing this tomorrow. This is going to be a winner. I just said, if you feel this way, it would be like me saying, here's Nietzsche's theory, or here's Schopenhauer's theory, and you saying, I disagree with you. Well, no, you don't disagree with me. You disagree with them. I'm just a messenger. I'm just telling you. Really enjoyed the part on Oklo when I played in the past, but I've avoided going back in with the price being so sky high. Single name rubric, Carvana next, wild story. Yeah, again, this is something that's well published and out there. Not following your concerns about EFR going up 4.1. As I understand it, this rate is mainly used by foreign banks and FHA banks because FHA banks cannot earn interest on reserves. You're going to have to explain that one to me. Let's say I accept your statement. My response would be, and? So what? Wouldn't a better gauge of liquidity concerns be higher SOFR rates? Well, SOFR will follow either 1 month or 3 month T-bill rates pretty much on the button, or even the standing repo facility. Well, we're not in a liquidity crisis. It's just the range is 4 to 4.25. It can be anywhere within that range before the Fed needs to step in. But these things are fairly stable. When you see 4.08 and then 4.09, then 4.10, you got to pay attention to that and say, in such a short period of time, these things barely move. Let's keep in mind it's really not a lot of movement here, right? That's not a lot, 4.08 to 4.1. But again, these things don't move. That's all. SOFR, the S means secured. So because it's secured, it will hold very closely to the 30-day T-bill rate or the 90-day T-bill rate. Can you provide more detail on what the energy sector designation will include? I know you said you're creating videos. Will these differ content-wise from the 12 or so primers you have covering each different energy subsector? Well, the videos will be a discussion of what's in the primer. Sometimes you read something and you might think, well, I don't get what you're saying here. But yeah, the videos are really just a repetition of what's in the written primer. I'd say it's a higher level kind of review and detail where I feel that maybe if I draw a picture of something and draw a picture of a reservoir, and the drilling of a reservoir, rather than just reading the words, you might say, oh, I get it. So if I show the source rock and I show the migration up to a reservoir with the cap rock over here and the drilling, you say, oh, I get it now. I see what you're doing. That's all that is. If you have the PDFs and you're adept at making your own notes and studying from your own notes, you'll be just fine. Yeah, that's all the videos are. Some people would prefer to do their learning with video. They'll watch the video, then they'll read, or they'll read and they'll watch the video. With this one, you have to do both. You're simply going to have to do both because some of these readings are 100 pages long. I'm not going to do an 8-hour video on 100 pages. About every 30 pages is about an hour and a half if I'm going to create video screens and narrate. So if you have a 90-page reading, I'm not going to do a 4.5-hour video. It's more high level. But the detail is deep in every video. In every reading, the detail is deep. And the readings that are up, some of those are first or second pass readings. As I create videos for them and I go through them, I recognize where, this paragraph to this paragraph is missing something. So it gives me an opportunity to upgrade the writing. Substitution of aluminum by copper. I know that energy consumption in Yunnan is being capped by China's government for data centers. This is true. Just read a document from Goldman Sachs mentioning the government of China last October, I believe, where they engaged massive capex to use ultra-high voltage DC that uses only DC current, which limits the loss of energy and renewable energy such as wind, solar, geothermal. Okay, well, without any loss due to electric conversion. They're trying to reach 100% of renewable energy to produce mineral. The U.S. government struggled to maintain a capex for their grid. What will happen if China produces more data centers? I guess I'm not following the question uh, to be able. What will happen if AI, if China produces more data centers? Well, then they'll use more power. I don't. I guess I'm not understanding your question. But they do have they do have different tests for energy consumption in particular regions that they do have a cap in that region, and the belief is that they're probably not going to raise that cap, which calls into question as they start using more data centers and more energy, calls into question the pace at which they'll continue to produce aluminum. I don't have an answer for your question, in part because I don't quite understand what you're asking. Any update on new mobile app? No update. 2023, you made a video about changes to CFA. There you also mentioned in 2025 we can expect a new module in the applied series about quantitative portfolio construction. Can we still expect to see this new module being added, or is it delayed indefinitely? So I evolve with the changing landscape, and I don't know that that having a quantitatively constructed portfolio at the retail level is a viable option. So not that it's off the table, it's just AI has allowed me to revisit projects in the past that I have dismissed because I thought it would take me way too long to get done. So it has allowed me to accelerate some of those projects. So I'm doing high yield stuff right now. That doesn't mean it won't be done or that I won't do it. Just I don't see it as a high yield project at this time. Regarding Fed cuts, your ZQ position, aren't you concerned that the Fed might skip the next meeting? No. You mean like just decide not to hold the next meeting? Not one bit. Heavily data dependent with no data coming in seems possible? No, not one bit. Only released part of the meeting will be CPI, which is expected to creep back above 3%. So you might have inflation, but no payrolls. No, they won't be skipping it. And the belief is that 25 is pretty much in the bag for this one. Powell has almost said as much. And Susan Collins is there, Waller is there, Bowman is there. We know Mirren is there. It would be hard not to get 25 at this meeting. The question is, will it be 50? Because if the shutdown lasts until the meeting, and you do have, I mean, the judges blocked layoffs for now, but that's never stopped this administration. If you do have continued layoffs, yeah, I could see that why wait till December for the next cut if you really do think it's going to be two more cuts this year. Let's just get them out of the way now. Let's see. Looking forward to the certification by sector. I'd probably prefer areas like real estate, consumer, cyclical, discretionary, and tech. Those are hard to do. Discretionary is hard to do. Not that it's hard to do. But one just for consumer discretionary would be a tough one. It's just so big. You have automobiles and components with like 4 sub-industries in there. You got consumer durables and apparel. You got another 10 or 11 sub-industries in there. Consumer services. You got 5 or 6, 7 sub-industries there. Consumer discretionary distribution and retail. You've got another 9 or 10. The size of it would be huge. You're talking like 30 sub-industries. It would be huge. Now, you could break it down into something like hotels, restaurant, and leisure and say, let's just focus on this industry. In there, you have 4 sub-industries, and you might have 3 or 4 adjacent technologies that you'd look at and bring it down to 7 to 10 readings. Or you'd look at retail and maybe just do one for retail, because you got distributors, broadline, you got apparel, computers and electronics, home improvement. You could just do retail. That would be a big one on its own. Automotive would be huge just on its own. Even though you only have 4 sub-industries, all the supporting industries, all the technology, all the transition technologies, that would be huge on its own. And listen, we haven't even left consumer discretionary, and I've already pointed out 3 or 4 big ones on their own. Energy is cohesive, right? You've got seven or 8 sub-industries. Let's have a look here. Where's energy? 1, 2, 3, 4, 5, 7 sub-industries and 1 sector, and maybe 4 supporting technologies in terms of transition, energy transition, and decarbonization. It's doable in one sitting. Consumer discretionary is just way too big. Where are we here? Enjoyed Oclo. Great to see more. Not just meme names or speculative plays like Octo, but also strong companies, solid fundamentals, similar to what you did with AT&T. I was going to do a rare earth company this week because I think that most people have a misunderstanding of how easy it's going to be. It's going to be brutally difficult. Even with the government backing it, even with offtake agreements, it's still going to be brutally difficult and a long timeline. And you have to accept massive amounts of environmental degradation. There is no other way. And if you think mining produces a lot of CO2, wait till you see what rare earths do. Rare earths produce so much CO2, it will make copper mining look like a green industry, right? That's how much it produces. It is hugely environmentally damaging. Huge amount of energy required to get this done in a country that's already looking at adding how many data centers, how many gigawatts of energy are needed in the US, and an administration who decided, no, we're not going to support any transitional energy. Solar and wind, screw that. Burn, baby, burn. This is a mess. You have to find it in concentrations large enough. There aren't that many areas in the US with concentrations large enough. One of them is in California. What probability do you place on that happening? California, come on. So it's euphoria with very little backing. So I was gonna highlight a pre-revenue rare earth company. Building the applied level at the beginning continues to be one of the best investments I've made. Buying the applied level. Yeah, in the beginning I think people only paid like $95, and it's huge now. I think Mark says he tries to deliver overwhelming value. Now with the introduction of these specialist courses, the trend continues. I'm sure you will get here one day, but I would be interested in AI ecosystem specialist. Oof. From chips to hyperscalers to cybersecurity firms. I see where you're going with that. Yeah, AI ecosystem. It's hard to figure out who the players are right now, and there are so many that are private. It's going to be hard to get good information on them internally. Like, how am I going to get information on some of these more private companies? Anthropic, Perplexity, OpenAI, to get the type of information that I would need. That would be tough, and it's so fragmented and overdone right now that any video I do on it is obsolete in 3 months, and if I do another video on it, it's going to be obsolete in 3 months. This one needs some time to settle out, but to hit some of these points, yeah, I will get there. I think the big spaces right now are energy. That is a lot bigger than what most people seem to think, because the world is going to need a hell of a lot more energy going forward, and it will be traditional and non-traditional, carbonized and decarbonized. Next, you got to build stuff. You're going to need minerals, from copper to aluminum, gold and silver. Look what they're doing. the platinum group metals, platinum and palladium, and rare earths are now in there, even though it's not listed in the mining sector. Sort of like within a sub-industry, gets very little mention. It should get a lot more mention now. I think that's a big thing going forward. But for AI, I seem to think I'd want the dust to settle first to figure out exactly, what the hell the industry is made up of. I think any time I spend on this, by the time I finish writing the last word, I would have to go back to the first reading and say, well, I got to rewrite this. Half these companies don't exist anymore, and then I'd rewrite all the readings, and I'd have to say, well, I got to go back and rewrite the first one all over again because this technology no longer exists. Now it's this technology. Oof, that would be a huge undertaking. Cybersecurity, there is a video up, Understanding Cybersecurity. That one is up. Trump Taco quickly this time. Yeah. In an effort to learn more about and become more familiar with futures, I sold 3-month SOFR June 2026 put contract with the underlying expiring the same month. I sold 9 October at 415. You're not telling me what strike. I bought back today, 4 days later at 35 cents. So 6.5 cents, 8.75. Margin requirement is 950, return of 162.50. It's about 17%. Okay. I may be missing something. The SOFR futures seem not to be pricing in the cuts in the same way that the Fed fund futures isn't. Oh, look at all those negatives. Seems to not be pricing in the cuts in the same way that the Fed fund futures isn't. In other words, it's doing the same thing as Fed funds and not pricing in cuts. Yeah, if you look at the forward curve of SOFR, it's going to hang very closely with the effective federal funds rate because it is going to be a secured overnight funding rate secured by the 1 month or the 3-month T-bill, and it is going to fall secured by treasuries, whether they be T-bills or notes, but they are secured. The 1 month SOFR will follow the 1 month T-bill rate, and the 3-month SOFR will follow the 3-month rate, and the 1 and the 3 will hug very closely to where the effective federal funds rate. So the forward SOFR curve should look like the forward or the futures curve for ZQ, inverted, because SOFR is a yield and ZQ is an index. So inverted. It should, or at least the R component should. Since the margin requirement is lower, could the return not be higher? By using like next October SOFR? I don't know that the margin is lower. You used a put. I'm using a futures contract. I don't know that you can compare them, and you didn't tell me what strike the put was at. So I don't know what your margin, what it would be had you just gone into SOFR futures. Do you cover future options in your course? Yeah, in the applied options module, there is one folder for futures, treasury futures, and in there are options on futures. I think within that one, I do talk about SOFR futures at the very beginning of the treasury of one for the treasury futures. Mentioned that in 01, you mentioned in 01, one of the signs of a bubble was some ridiculous IPO each week. This was before 01. 99 and into a little bit into 2000, it was 3 IPOs a week, and that IPO on Tuesday at 50 and end the week at 300. That's what was ridiculous. It was just everything just went. Currently, we aren't seeing IPOs like that, but it seems what we are seeing is all these circular deals between tech companies, often OpenAI and something like Oracle and AMD. Yeah, I do see that, and at some point, OpenAI is just not going to be a viable counterparty, spreading itself this thin. Unless one company says, okay, we'll spend 50 billion with OpenAI, and OpenAI says, okay, we'll spend 50 billion with Nvidia, and Nvidia says, okay, we'll spend 50 billion on who knows what, and they'll spend 50 billion with this company. It reminds me of that riddle of the innkeeper, where you have a guest going to the innkeeper saying, I would like a room. And the innkeeper saying, well, it's $20. So the guy gives him $20, and he goes upstairs to look at the room, and the innkeeper runs over to the tailor and says, I owe you $20, here's your $20. And the tailor runs over to the supermarket and says, hey, I owe you $20, here's your $20. And the supermarket runs over to the farmer and says, I owe you $20, here's your $20. And the farmer stayed at the hotel one time but couldn't pay, so the farmer runs over and says, here's your $20. Guy comes downstairs, says, well, I don't want to stay, can I have my $20 back? And off he goes. So the person who came with the 20 left with the 20, but nobody owes anybody any money anymore, right? So that's sort of the riddle we have with all of this circular money is what is really being created if the money is just passing from hand to hand to hand to hand to hand. If you think about Nvidia gets revenue, and then of course it has net income. And if you think about OpenAI, you'd say, well, it has to be offset with an expense. Well, no, that is an asset that is depreciated over time. So what happens is you have massive income over here, but no expense, right? Sort of creating the illusion that there's money there, but it's just because it's sitting on a balance sheet as opposed to sitting on an income statement. However, said another way, what other chips is OpenAI going to buy? You kind of got to bump into Nvidia along the way, right? And as far as companies go, what other AI provider are they going to have? They can have Gemini, they can have Anthropic, but OpenAI is there. They buy Gemini. Well, Google might be their competition if they buy through Anthropic. Well, Amazon may be their competition. OpenAI is, really not doing much. When you're that big and you're walking around looking to get deals done, you're probably going to bump into each other along the way. Let's say that I need some work done on my house, and I call a company to do work, and the company that comes over says, we need an investment advisor. I say, well, I do that as well. And we do business with each other, and we decide that, well, you'll do this for me and I'll pay you, and then I'll do the service for me and you'll pay me. Is that any different than them doing work at my neighbors, getting paid from my neighbors and coming over to me and doing work for me? You could say, well, it's not uncommon for two people or two companies to bump into each other saying, hey, you got what I'm looking for, and the other one says, well, you got what I'm looking for. This is what we saw in the dot-com era, where you had one company saying, listen, we're going to spend $20 million of advertising on your site. And this company saying, well, we'll spend $20 million of advertising on your site. Revenue, 20 million. Revenue, 20 million. Advertising, 20 million. Advertising, 20 million. Look at how fast we're ramping up revenues, and we're ramping up advertising because we're getting eyeballs. Meanwhile, nothing really was going on. But the story, oh my God, look at the eyeballs they're getting. They're spending money in advertising. This is what we want to see the company doing. Revenues are scaling at the same rate, and it all looked good till it didn't look good anymore. Because you look over on the cash flow statement and you say, there's no cash flow. Where's the cash flow? So here, the revenues and the asset, the balance sheets and the income statements will look good. Pay attention to CFO. Somewhere along the way, money has to leave. If money's going to show up on other people's statements and everyone's doing the circular business, there has to be a hole in cash flow somewhere. It has to show up somewhere. unless everyone's just doing it on receivables, in which case you're going to have huge accruals showing up. So look to the cash flow statement to see what kind of effect that is going to have. But overall, I'd say, yeah, it's a lot of circular deals. But I mean, if Microsoft needs, servers, they'll go to Dell, and if Dell says we'll need cloud services, well, Microsoft does that. I mean, could they not have decided on their own that they were going to do business before they said, hey, you're here? Oh, we're here to see you. No, we're here to see you. Oh, well, what do you know, right? It could just be something like that, although it doesn't seem that way. You mentioned, so since the start of last week, TLT has been up, S&P has been falling. Is this the bond market finally responding to weakness in the economy? Oh, I hate to say yes. Because I have been treated badly by TLT for 2 years now. Every time I think we're dating, TLT breaks up with me, and then down it goes, and then we get back together, and I think we're dating again, and TLT breaks up with me. It's like a bipolar stock, a bipolar ETF. So it's behaving nicely now, but maybe because it's on its medications. I mean, it might stop taking its meds tomorrow, and who knows what's going to happen by the end of the week, right? I don't know, does that analogy help you? Once bitten, twice shy. Well, 10 times bitten, 10 times shy. Any thoughts about Lex Frieden? Have you watched his conversation videos with various people? From time to time, yeah. I don't know that I have any opinion one way or the other about it. What are your thoughts on Kohl's? I have no thoughts on Kohl's. $35 a share. They have $35 of share value just in their commercial real estate equity. I don't know anything about Kohl's. You said in different video, banks and insurance companies are different from all the companies because they originate their assets. I've read this before. I've answered this question, I think, twice now. I'm sorry, I'm not going to answer it again if you're not watching the Q&A videos, but you're asking the questions. Well, can't help you. Who are some investors you look up to and influence the way you think about equity and other asset classes? Well, that's a good question. I probably say no one. Not because I don't respect other investors, but you're saying that have influenced the way I think. Most of what I know I had to figure out on my own. When I started, no one would talk to you. And I didn't live in a world that you live in today where there are videos online of interviews where you can hear people talk. I mean, YouTube really didn't show up till 2003, 2004. And no one really, other than cat videos, no one really posted anything interesting to YouTube till maybe 10 years ago. It really started to explode into something interesting. But previous to that, it was full of entertainment. There wasn't a lot of good quality stuff on there. The podcast format really is less than 10 years old. So you didn't have this kind of information and this kind of access in the late 90s. The internet was there, but it wasn't what you think it is today. And even if you knew some people that were working here or working there, if you called them or even saw them and asked them questions, nobody told you anything. Who the fuck are you that I need to tell you anything? Go figure it out yourself is the kind of answer you'd get. I ain't got fucking time for you. That kind of stuff. Like it was almost like it was really just that rude. No one would talk to you. You had to figure stuff out yourself. It's different today. You can hear a lot of people talk and form a lot of opinions. If you don't know what you're doing, it all sounds realistic. The more you educate yourself, the more you listen. The people you listen to in the beginning, you say, 2 years ago I really thought you knew something, but now that I know all of what I know, you're kind of just average, aren't you? So as you learn more about something, you start to realize that some of the people that you thought really knew what they were doing really had just more of a surface view of it. There's one in particular that I 2 years ago I would have said that's the one you listen to if you're in this particular sector. And I just listened to one of their interviews they did 3 days ago, I think. And I heard them speak. I thought, now that I know more about this particular topic, no, you're wrong over here, or at least you're light. You're missing the nuance of something. But people that I would want to have a long conversation with, over dinner, Cliff Asness, Howard Marks, Jeffrey Gundlach. Although I don't quite agree with his conclusions, I like his systematic approach. I like he runs through a whole bunch of neat charts that I like to see. So I like that, just all the data that he compiles. But if you put Warren Buffett on the list, I'd be thinking, I don't know. I don't find a lot of depth and good intelligent statements in there. I find a lot of folksy, this is the way we do things. I find a lot of that stuff, and it's like, you're not giving me anything though. But I think that's part of his style, is that he plays very, very close to his vest. He's not going to show you his cards at all, and then he'll talk in a way that makes it seem like, it's really just this simple. You look for good management, you look for this, and that's all you do. And I'm not really working that hard, and it's really just, he makes it seem overly simplistic, I think, and I don't get much when he talks. Not like with Howard Marks. I get a lot out of him when he talks. But as far as influencing the way I think about equity or asset classes, I gotta say nobody, because I had to figure it all out myself. What podcasts, YouTube channels do you listen and watch for unique investing insights? None for unique investing insights. Bloomberg mostly. By the time Bloomberg is done and you go to YouTube on the weekends for the podcast, I'm hearing everything I already heard throughout the week. So I'm not really getting a lot of interesting stuff. And I don't really have the time to run through 7, 8, 9 hours of podcasts. You got maybe a couple hours on the weekend, so you hit the highlights and that's about it. But on a repetitive basis, not a lot. I used to watch All In when they were called the All In podcast. I used to watch that because it had a great view on the venture capital industry I couldn't get anywhere else, and it was interesting. But since they changed their name to the All In on Trump podcast, I've simply lost interest, because it's really just four guys with an opinion, four guys that are detached from the average person, that are detached significantly, four billionaires with an opinion that a lot of people are probably in a better spot to have a better opinion. And I don't know that their opinions are any more informed than anyone else. I think their opinions are extremely biased, because again, it is now called the All In on Trump podcast, and when this is all over, they are going to have to live with this All In on Trump business. So they better hope it works out, and he is leaning more and more towards dictatorship. I don't know if anyone in America sees it. It's Bill Maher calls it a slow-moving coup, but it's picked up speed. The idea that the Pentagon now says media outlets must get permission to print what they want to print, or they can't be here anymore. The sending military into cities, that's the beginning, under the guise of making the cities safer. That's the beginning. Telling all the generals we have to fight the enemy within again. Look to the words, right? Look to the rhetoric. Slowly, what you're going to get is, and this will probably start in the new year, is words along the lines of the deep state is still there, folks. We're seeing evidence of the election. It looks like they're trying to rig the election again. We're trying our best to stop them, folks, but we don't. This goes deep. This runs deep. And as you get closer, we may have to delay the elections. We can't guarantee a secure election right now. and the Democrats, the left-wing lunatics, and that will grow louder. And then it'll be, we have to cancel or delay the elections for a couple of weeks. We can't figure this out. This runs really deep. We have the FBI looking at it, and there'll be arrests and there'll be show trials, and there it is. There's where you're going to get to. That's what you're going for. I'm saying it now because when he starts saying it, I want you to say, "Oh, look at that. He said it." You know, and maybe in saying it, some people it might encourage some people to do something such that doesn't happen. I don't know. But I see it from the outside. I can see it. I can see it creeping in. He wants to be a king. He wants to own it all. He wants to be a dictator. This is why he's appointed people who don't have a brain of their own, who will not think on their own. And for those that have a brain, he'll feed them inside information so they can make millions of dollars, so that they just always do what he says because they don't ever want to lose that pot of gold. He is brilliant in that particular respect. I will give him that. He does know how to take over, and take over he will. How would you structure a bear put spread to hedge against a potential S&P decline over the next 12 months? Well, first of all, I'd never do that. That's too long. 12 months is too long, because what could happen is you put your bear spread in to protect against the next 12 months, and it runs up and up and up, and boom, it drops 10% and then does this, and there's your bear put, worthless. Hasn't protected you from anything because you've allowed the market to get way too far ahead. 12 months is too long. You do it 60 to 90 days at a time, so that after 60 days, you didn't spend a lot of money. This is gone. The market's up here. You can do another one up here. And if that disappears, you could do another one up here, and boom, oh, look at that. That protected you. But I would never do a year. A year is, because it's not that it'll be lower in a year. You're expecting that there'll be some kind of downturn over the next 12 months, but the market could go up 20, 30 points before it drops 10 or 15. And your bear put is worthless at that point. How much capital would you allocate to a hedge like this? Oh, I can't answer that question. I know nothing about you. I know nothing about the size of your portfolio. I know nothing about your age, what your long-term goals are, what it is that you're holding in your portfolio, what asset classes you have. I know nothing about you. I would simply just be pulling something out of my ass and saying, I don't know, here you go. $10,000. How's that? See how silly that answer is? Because, well, right, you can't ask these kind of questions. Would love a detailed breakdown. You give me a detailed scenario, and I can give you a detailed breakdown. It's sort of like the question, hey, how's it going? Do you really want a detailed answer to how's it going, or is it one of those things of it's going pretty good, right? So, yeah, without detail, I can't give you a detailed breakdown. How come you're not talking about gold and silver? What? Especially silver. Okay, you're putting a comment under a video in which there was a whole section on gold and silver. Especially silver. And I expanded on silver a lot. I mean, are you even watching? It is still cheap, and it will keep making bullish momentum, possibly passing 230. What? Because there's not enough silver is not easily available. How come you are only talking about... Okay, so you just weren't watching anything, and you think silver is going to pass $230 from $50? You think there's 500% upside to silver because there's not enough silver? There is a projected deficit in silver, but not to justify two. Okay, well, I think you're just trolling me here. That's the end of this one.